Hello, everybody. Kirk Spano here. I am back from Las Vegas, and just thought I'd tell you a little bit about what I saw and felt and counted and everything else, and then get into a little bit about what the market is looking like to me. And we will have Shooter on as well, who's going to go through a couple of his charts, and we'll see that our charts seem to match up even if we get there different ways. So, in the last week, I've been in Las Vegas, once again playing poker, and I came away with a number of lessons. First off, Vegas is still very busy. It's not quite as busy as it was at the end of June. I suppose this has something to do with people not planning to go to Vegas when it's 175 degrees, but it was still very busy. On my second day there, they instituted the mask mandate again. I did not know that was coming before I went. But I did bring a few masks with the intent of wearing them because I know that only half the population is fully vaccinated. Another 20% have gotten one shot. Not really sure why they haven't gotten the next shot. I'm sure some of them are just waiting to do it. Others, I think, probably just don't plan to do it. And about 30% of the population is not vaccinated, and they're not real apologetic about it. And they don't really wear their masks up over their nose. They cover their mouth thinking, hey, this is good. What are they going to say to me? Well, what the people at the casino said to them, seeing as everything is recorded, is put the mask over your nose or get out. And I heard that a number of times to the point where some of the irregular patrons on the poker table, the grinders, the regs, they were telling the tourists, put your mask over your nose. And it was pretty interesting to me that there was some vitriol towards that. In fact, there was one guy shooting off his mouth on a different table from me. And I asked for a table change because I wanted to go over to his table because I thought, well, he's the kind of guy I can irritate and get some money out of. And so I sat at the table and I had my mask on, and he kept pulling his mask down below his nose and pretty much had it below his nose most of the time. And he'd talk and pull his mask down below his mouth, and I can't remember exactly what he said, but I was wearing my Democratic National Committee mask at the time, and the reason I wear that is because it's blue, which I like, and has a bunch of donkeys on it, and I like that it's got all the donkeys, so it didn't really need to be a Democratic National Committee mask, but I thought it was fun that the guy across from me asked why I'm wearing a donkey mask, and I said, because I'm that bad of a poker player. So I thought I'd give it away and just let everybody know I'm a bad poker player and I wear a donkey mask. And I said, but it is also my Democratic National Committee mask. I gave half of my money that I made playing poker last year to the DNC. And the guy at the end of the table, who was clearly a quite red person, looked at me and he's like, really? How much you give him, like $100? I said, no, I'll give him that much from your money today. And he didn't like that answer. So we got into a hand a couple hands later. I just rolled in with a pair of kings, flopped a set of kings. He thought he was pretty good with a ace queen, and he bet it. I called. Turn came out a queen. He has two pair, aces and queens, and he bet it. I raised. He went all in. I called. River blanked. Really was nothing to help him but an ace, and I took all his money. And he wasn't very happy about that, so he put a couple $100 more on the table. And we played a little while longer. I took $40 off him and then $30 off him. And it really was pretty easy to pick on him because he just wasn't a very smart man. But he was angry. He was easy to get worked up. And I felt like teasing him just because he was talking shit about things he didn't understand. And what I'm discovering is there's a lot of people who talk shit about things they don't understand. And there's not really anything you can do about it if you do understand, because if they don't ask for the explanation and you give it, doesn't matter. They don't care. They're just going to make their own stupid statements. And there's a lot of stupid going around right now. One of the stupid things that's out there is the valuation of the stock market. The stock market has a price to earnings ratio of around 40. That doesn't mean every stock has a price to earnings ratio of 40. It just means that the S&P 500, on average, PE of 40. And this is after a period where earnings have had a significant rebound on the back of a reopening. So I think the question that we all ask is, can the earnings just keep going up at the rate they've been going up? Well, if Amazon is any signal, and I'll have Scott talk about this in a minute, if Amazon is any signal, the answer is no. Because if Amazon is warning, what chance do the rest of them have? Because Amazon's got a great business. So, Scott, are you mic'd up? Are you ready to speak? Can you hear me? Can you talk?
I am ready.
Oh, there he is. All right, bro. I had the wrong speaker on. Hi, Scott. How are you doing?
Hey, I'm doing good, buddy. Hey, I was just telling everybody it's usually me who is technologically challenged.
So let's kind of do this interview style, and then we'll go through some things. You'll be able to see the screen.
Okay, cool.
So what I just said here a second ago about Amazon, I know that you had put up a chart. This one?
Should be.
All right. So here you go, Scott. Tell us what you're seeing with Amazon.
All right, great. Well, Amazon, actually held the 200-day pretty sound, but I've got one count that looks like we might do a little more of a pullback down to around 32, 39 there. Otherwise, the daily has a different count and says C is in. So, we should push to that 5 either case. I don't think we break down more than that. I think we need more of a catalyst. So now if you want to jump over to the next chart, actually go over to Facebook. I wanted to go through the fangs real quick. Okay, now Facebook, obviously, if you're long, your stop should be about 347. We're looking for a 5 at about 403, which is a sell. Not a deep retrace there. I only see 355 on the pullback. So we'll have to look. Now, the one thing that I have, Motive Wave sees it a little deeper at 307. Now, just so everybody understands how I set up these charts, I have a set format I use with Elliott Wave for the motive waves, which are the euphoric waves up, and the corrective waves, which are the ABCs down. And typically how I set these up is the exact same way. I trade this ABC pattern. If I get a deeper retrace, the 72 or the 78.6, a close on a daily or a weekly below that, then I'm looking for a continuation. If I don't get that, then I'm not looking for a continuation. For example, if my retrace is at the 61.8 and it stops there, as far as I'm concerned, it's not continuing. At the close, if it's below that 61.8 and below the 71.8, I'm looking for a little continuation. Okay. Jump over to Google real quick.
Well, hold on. Let me ask you some questions.
Sure.
All right. So this trend, you have identified all the way out to the end of 2024, start of 2025.
Okay, now the way the count works is there is no time frame for Elliott Wave. However, the historic gaps in the wave counts, in other words, the 5 wave ups, the ABC corrections, gives us a historic timeline. So you can actually do a time analysis and it's going to be within a range, very much like cycles do, but you can't be very exact out on a weekly or a daily. But you can go down to a 15 or 30-minute chart, and you typically can be within 20 or 30 minutes of your count.
So if you're trading super short term, you can
very accurate.
Narrow the range, right? But then over the longer term, which is what I've talked about before, is you get this, and I've actually used time charting from Elliott Wave. I've never thought it was that good, but it kind of shows you about how long things will take, right? So if we're at 380 or 360, whatever Facebook is now, and you're seeing the upside to around 400, and I'm a long-term investor, that's not a super sexy chart.
No, that's why it's there.
Right.
And if you look at all the, basically my consensus of the fangs, all of them, with the exception of, Netflix really is in some type of consolidation or topping pattern. Now, Amazon, if it doesn't break down here, because if the economy breaks down, Amazon's going to break down. That's, it's too big. It's sort of like with oil. If the Saudis cut production by 50%, what happens to oil? We're looking at 200 oil. I mean, it's like they own too big of a piece of the pie. So if they end up being affected by the economy and people stop buying and Amazon stops shipping, there's a swan event there. Yeah.
So Amazon, you're saying, is upside to around 4,000, which is
a decent upside there, actually.
Which is about what I've said. So you're down here at 3,500. The question I think that people have to ask is, what time frame are you trading, right? So everybody has to ask themselves, what am I trading? Am I looking for 3 to 5 years out, or am I looking for 3 to 5 days out, or 3 to 5 weeks? So what Scott is doing is helping you ride these trends kind of in real time. So if you want to trade a little bit more frequently, a little bit more short term, tighter stops, then this is going to be pretty helpful to you. But again, this is another chart where I say, all right, so upside from 3,500 to 4,000, if it takes a year or two, I guess that's okay. But if it takes longer, again, not super sexy. And if folks remember, what did I say several months ago? I said, I wonder if we're at peak Amazon, because I'm taking a look at their expenses going up and wondering, in a world where Facebook is about to challenge them and Shopify is doing well, and you've got all kinds of challengers coming now, how much more of the world can Amazon absorb? And does it double in size over the next decade? Maybe, but that's a 7% annualized return. So where are we really going to find excitement in stocks? Are these the stocks that we think are going to make the next 10 baggers and 5 baggers and triples?
No, I don't think so.
I don't think so either.
Yeah, I think the FANGs, though, are, just like they led, I call them the generals. Go to Google real quick. The reason I look at the generals is because it gives me an idea where a majority of the 401ks and IRAs are invested. I mean, if you look at the percentage of people who own those. So, looking at Google, we're in a little bit of a ABC back to about 2658. And then we push for a 5, which is really within a 3. And then we back test again. And then we go on for our all-time high, which will be around 3,000. Now, that pushes off. Now, that's, timeline, what you're seeing on that chart could be anywhere from really January to March of 2022. A normal top would come in. However, with that euphoric push up, if you continue that parabolic curve, that 5 could actually occur really by the end of September or early October. So, I mean, it just depends on how euphoric that move is in Google. It's a pretty solid looking chart. Now, one thing it did give me is on this last high, we did confirm. Now, that basically is my first indication that we're potentially have a 3 drive to a top. So, that's something that I'm watching now. And then if you want to flip to next Netflix, if you don't have any other questions, go for it.
Okay, there you go.
Okay, and Netflix, actually is one of the more constructive looking charts because I like that flag. It didn't really pull back. It sort of held the flag. It didn't come back and back test the lower high or the higher low, excuse me. So I've got a buy down at that 478. I didn't actually post that because we weren't tracking Netflix at the time, but we should push up to about 630 and put in a 5 and then do a little ABC correction back down to the 61.8 about 515 and then go on and put in a new all-time high, around 675, 650.
And this could take a really long time. So, I mean, this could be a number of years. Again, I take a look at this and I say, okay, not too sexy. Google wasn't too sexy either. The reason I still like Google, though, is because of the baby Googles that they'll spin out over time.
Right.
And the reason you buy Amazon on a deep pullback, if there's a correction, because it's still Amazon.
Right.
And eventually, you got to think that they spin off AWS. So, you take a look at these things and you have to go company by company. One thing I want people to understand is these are gigantic companies, right?
Yep.
And Google and Apple sit on a mountain, Facebook sit on mountains of cash. Amazon and Netflix, not so rich, right? They operate on cash flow. So if their cash flow takes a hit, short-term problems, first world problems. But, share price is emotionally driven. And if people start to hate on it, they can hate on it for a while and drive it real far down. So we want to find those opportunities when people decide, I hate Amazon right now because I heard this thing about this other company. And, they go chase the other company and they find out, it's not all that. And they go back to their old girlfriend. So, the market moves around and we have to be aware of that. But one of the reasons that I've been steering you towards smaller companies, especially some of these post-merger SPACs, is we get a chance to evaluate these companies during a period when there's not a lot of interest, not a lot of analyst coverage, and we can say, okay, what is this similar to? You know, why is Discovery looking a lot like Netflix to me? Why is Viacom kind of exciting to me? You know, why are all of those space satellite as a service stocks interesting to me? That was the video that we were watching, and we didn't get all the way through it. But, you know, there's a lot of companies out there valued at a fraction of what I think their future market caps can be. And it's easier to find a company that's going to make a 5-bagger or 10-bagger if you look at $1 billion and $2 billion companies versus 100 and 200 billion and $1 trillion companies. Sky's the limit, but at some point you get to the clouds and you're like, I'm just going to float around now, which to me is what it looks like Netflix is going to do. I don't think Netflix has a ton more upside. I really don't. I think that this, from here a couple years ago, from 2018, all the way up to where we are now, I think that priced in the future of the next 10 years. And I say the next 10 years for a specific reason. Everybody says, I don't understand the Shiller CAPE ratio, excuse me. And the Shiller CAPE ratio is basically just saying, this is what your expected returns are over the next decade based on historical price to earnings data. And, you know, you can adjust for growth rates, but it's a 10-year lag. So all those growth rates are basically built in. The 10-year expected return on the large caps at this point is low single digits for the next decade. And I don't know how we get there. I don't know if we have a big run up and then a crash. Do we chop around? Do we do a sexy dance? Do a little spin, right? I don't know. But, you know, we can trade it super short term with the tight stops. But if you're really looking to be a buy and hold investor, or somebody who's going to have a lot of buy and hold mixed in with some other ideas, you know, you need to take a look at companies case by case and say, okay, this satellite company is valued at $3 billion, but it's getting into an expansion of the cloud that, you know, the cloud could grow 500% over the next decade because of all the new data sources, largely driven by Internet of Things, but also the whole satellite revolution that's going on. You know, they're talking about launching thousands of satellites in the next decade. And at some point, the government's going to have to say enough is enough. But the companies with first mover advantage, which we're getting involved with, you know, these are companies that, if you think Amazon is a big company, which is largely on the back of its web services, that's 70% of their profit, you have to say, well, if we're going to see a 500% increase in the cloud, you know, Amazon can hang in there for sure. They're already big. But what about these companies that are valued at $1 billion or $2 billion or $3 billion? How big can they get? What if they just get to be 5% of the size of Amazon? So Amazon's $1 trillion, give or take. Would you take a company that's worth $3 billion today to say it was worth $50 billion in 10 years? Would you be okay with that? I mean, that's more than a 10-bagger. I waited 7 years to get Exact Sciences to be a 10-bagger. But when it finally hit the hockey stick, right? When it finally hits the hockey stick, these things happen. So I know that everybody wants to be right in time. They want to buy it on Tuesday and have it go up 50% on Wednesday. And in the Reddit world, sometimes that happens. But usually you just have to be ahead of the crowd. And the crowd comes in when the analysts come in. So right now we have a lot of companies that are pre-analyst, pre-institutional investor, but with really tight share supplies. So Scott, what happens when a company with a limited float gets a whole bunch of interest?
With a limited flow, typically it runs.
That's right. It runs, and it runs hard because everybody wants the shares.
Yeah.
So that's why I keep talking about the smaller companies. All right. What else do you want to show us? Anything in particular?
Jump to the US dollar JPY real quick. Let me, that was my premise for posting the fangs. Okay. Now, if we go back really to the beginning of time with the Brentwood system here, is really what we have back at 1. The US JPY, there was a direct correlation to the S&P. In other words, US JPY declined, equities rised, okay? Then number 2 is where we hit a bottom in the US dollar JPY, right there. Then we topped at, what was that, 167, and equities topped. Now, I'm going to jump over because this whole chop between then and really 2016, really, there was a lot of volatility. Now you have the onshore yuan, or the yen. Put most of it on there as FXY, which is the light green.
Okay.
Now, notice how the distortion started there. That is when we had a major event in the financial markets. Now, we had another top in the UJ, and our correlation started to wane there with trading equities. You used to be able to look at the JPY in the overnight market and open up in the equities in the morning, and you used to be able to trade it. And people taught that as a trading strategy. In late 2020, it completely broke down. But what happened in 2016 that changed? Does that anything remind you about 2016? What happened then?
Oh, the unwind. There you go.
The complete unwind. Now, where are we now? We have the largest cyclical QE. If we go over, now jump over to the Qs as the next chart. Where are we now? We have the largest QE that has occurred in the history of mankind right now. Now flip back to that St. Louis Fed for a second.
One moment, please.
I know I'm making it difficult. I could have just flipped through it, but hey.
No, I actually have something I'm going to show you.
Okay. Now, just like in 2020, the correlation between the UJ and the S&P started to wane. However, the correlation is starting to be consistent a little bit again. On the upticks, we can follow the US JPY. On the downticks, we can also see it. If that correlation aligns again, we had roughly 18 months prior to 2020 where you could trade off it as a tell. And that is kind of exciting for me because that was some of the best trading periods in my career, because I was like accurate 90% of the time during that time. And that was before I had motive waves. So I'm looking forward to that. But now we can flip back to equities if you want to. That was sort of my point. I think we're reaching a tipping point where when the Fed unwinds, that correlation will be much more consistent in equities. And what we might actually see is a downturn there.
Right. So that was actually one of the things I was going to talk about today. We haven't even coordinated and look, we're on the same page. So this is my account at the Federal Reserve. This is a chart that I like to put out. And I don't know how to make this bigger, but pull that out. And looky. When the Fed started to taper, which is what he showed you a second ago, we got that correction, and that's COVID. And what happened here in September, right there, started to get a correction in the stock market. What happened right there? That was the repo market.
Yep.
Then they started printing money. And just that little bit of money, basically taking something that had been taken off and putting it back on, drove the market back up. Then we had COVID, and they printed gobs of money, and they're still printing gobs of money to push the market up. At some point, and who knows when that is, the Fed has to pull back. And if you listen to some of the Fed governors in the last week or two,
it's coming.
And, when I'm in Vegas, that's what I do. I just put on my podcast. I listen to the Fed. No, that's not really what I do. Harita today and yesterday was talking about, the inflation is getting concerning. And I'm a slow growth forever guy. I don't think ultimately the inflation is going to be a problem. But we are getting a resetting of price levels. And you get that roughly every generation. There's a period. The last time it really happened was the 70s. So it's been 2 generations, and the price of everything is jumping up. Now, the price of your chicken, your lettuce, your rubber tires, none of that stuff's going to go down in price again. The levels that we're getting to are going to hold. But in a year or two, they'll stop going up. So between now and then, between now and the next time that we need economic help, the Fed is going to try to trim a little. It'll be token because, look, from here to here is not that much difference from here to here, right? I mean, they just took a little bit off. No big deal. but it still gave the market indigestion. Why does that happen? It's because the cost of money goes up, which means that margin accounts get tougher to maintain, and the money starts to get sucked into physical projects. So what do we have coming up now? We have an infrastructure bill coming up. You're going to see real economic growth offsets to the slow growth forever economy. And it looks like they're going to do what? Rebuild the world, because they all know that that's what they have to do. If you ever seen those shell games, where you gotta guess where the ball is, that's a lot of what's going on right now. There's a lot of misdirection. I told you 6 months ago, maybe even longer than that, that what they've done is they've pulled forward the bailouts of the future to today, because we all know that the retirement system is in big trouble.
It's broke. They've been issuing haircuts.
Yeah, see how much I've grown up in the last week being in Vegas? A week and a half ago, I would have said deep shit. But, I said big trouble instead. So in any case, I think that people have to be careful thinking too short term and too long term. You just have to understand what the long-term picture is, and that will help you follow the money as to why things are happening today. Now, there's no doubt that just like President Trump tried to buy an election by doing quantitative easing that wasn't necessary, that the Democrats are printing all kinds of money through fiscal programs because they want the world to be the way they see it. And ultimately, we're starting to realize some Greek philosophy here. When the population realizes they can vote themselves money, we're all doomed. So I'm not a big guy on thinking that there's going to be a depression, but there'll be another recession probably later this decade. And between now and then, the market will sniff it out and it will adjust. And part of that adjustment will be tied to whenever it is the Fed says a little bit more definitively, it's time to take a little off the table. Because when the Fed levels this line off, which is all they're going to do probably, I actually have a hard time believing it'll go down. I just think they're going to level it off, right? To me, the odds of them buying any of this back is almost zero, right? I think what they did here was actually pretty spectacular because I didn't think they'd pull it off. I just thought this would go sideways forever. But they did this, it caused the repo market. I mean, and this really did cause the repo market to fall apart. The banks rebelled. And I have said a number of times, they ought to just raise interest rates a quarter point rather than cut the quantitative easing. Because when you cut the quantitative easing, you cut liquidity. Why not normalize the rates first? And Yellen's hinted at it, but it's up to Jerome Powell between now and January. And I still don't know what Joe Biden's going to do about that. So as investors, when there's a big correlated correction, right, it becomes easy for a minute. We bought a lot of good stuff. We just didn't buy enough of it. We'll get another opportunity to buy Amazon and Google on the cheap and Apple maybe. But it won't be super cheap. And the biggest money will still be made in little companies that become big companies. And then if you're trading around the edges, using your tight stops and following your charts every day, Scott's got an amazing record. So you can make those little trades and pick a point here and a point there and 5 points here and 3 points there and 10 points there on 1% or 2% or 5% or 10% of your portfolio, right? How much of your portfolio do you trade, Scott?
I honestly, a very small percentage. The biggest chunk that I have on right now is in crypto. I'm less than 5% across the board right now. I don't put a lot on the table, and that's because that's part of my risk management policy. And the reason I use the risk management policy the way I do is because anything in a swan event can blow up, especially when you're trading options, in even futures. I had one treasury trade on one time that cost me $250,000 just because of a blip. And you get you have these stop runs and everything else that occurs. So I've structured my entire trading around a model of risk management. Typically I come in with a specific figure when I trade an option to put a piece on because I'm watching it. That way it's right in front of me. And then once it starts working, I scale in, and then I also scale out on the other side.
Where folks, where have you heard that before, right? So I think that it's important that folks understand that when we look at all these charts, right, when we look at all of these charts, we're trying to figure out the big picture, and then we can trade it a little bit in real time, but really the shorter term time frames are giving us hints as to when the future is going to get here. So
keeps you connected to the trend. What it does.
And I think I still like this level here. It's right around 350 on the S&P 500. And I could see something like that over the next decade. Now, does it go up a little higher before it comes down? Or are we getting really close? Well, if you're reading anything right now, you keep hearing seasonal, right? We're getting to that seasonal quarter where we just started it. The third quarter is historically the worst quarter. And in fact, the real return is basically right on top of zero.
And what's that phrase? Sell in May and go away?
Yeah, and I've changed it to, sell in June, avoid the swoon. But, I think that folks need to understand that we're at a point in the market where valuations are super high. Showed those charts 1,000 times. And the Federal Reserve is talking about tapering. Now, 6 months ago, I told you they were talking about tapering. Now they're actually talking about tapering, which means the next thing is tapering. And everybody's trying to game it to like within a week. Do you really need to do that? I've been trying to tell you for a few months, start to scale out, sell covered calls, sell more covered calls. It's okay if something gets called away from you. And if it doesn't get called away from you, at least you put some money in your pocket and just keep accumulating that cash. You saw what my holdings are. If the market dropped 30% in the next quarter, I would probably just buy a huge swath of QQQ. Simplest thing to do. I have my 20 stocks, mostly smaller cap. I throw some QQQ on top of it. Now, if I'm a dividend investor, probably run out and buy Pfizer. And I saw, Scott, you put up something interesting on Pfizer. You tagged a tweet. Somebody, a couple of weeks after I started talking about Pfizer, somebody bought a ton of calls on it. What was it, 7,500 calls for?
Yep. Some of that was out of Congress, too. They were buying on the fact that they were going to legalize or whatever where they cleared the vaccine.
Right. Well, and I think the important thing with Pfizer is, like Moderna, they have really put together an AI-driven platform for using mRNA to do vaccinations. And it took me a year of studying it and trying to understand it. But it seems to me that mRNA is the future of vaccinations. It really does, because they can keep up with whatever gets thrown at us. And if you're following COVID, it's mutating, and we knew it was going to happen. And it's a pretty serious set of mutations. If you saw one of the articles that I saw today, is we have found COVID in the deer population now. So it's jumping species somehow. And the Lambda virus, which is South American, seems likely to supersede Delta. So the Delta variant is the one that's going around right now. It's way more contagious than the original COVID-19 that we found. The
main reason is it's targeting a younger population. My daughter's an RN.
Okay.
And right now, the bulk of the people in the emergency room, and they're full, by the way, are age 40 to 60.
Yes.
So it's a completely different age population.
Right. So it's gone from elderly to middle age. And that's because, and just think of this simply, the virus needs more to eat. And that's the way to think about it. I mean, that's maybe not the best word, but the buffet that it was on first ran out of hosts. Now it's moving to the next group, and it's adjusting to go to that group. Well, the Lambda virus, I believe, is a little bit more deadly, just as contagious. I think that one goes down a little bit in age as well. I've been reading up on it here in the last week. There's not many cases in the U.S. yet, but as you might imagine, some of the states where there's breakouts are seeing it, right? So it's Florida, Texas, I think it was one of the Carolinas, South Carolina. We're going to be dealing with COVID, folks, for years. Until we have, and they basically just said it. They said, look, I think we probably need 90% vaccinated people out there to really get herd immunity. So, until we have a greater vaccination rate, it's going to be there. And even though it's 50% in this country fully vaccinated and another 20% partially, the rest of the world is not even close to that. So, a handful of countries. So it's going to be around. It's going to keep mutating. And what have I told you? The thing that we have to avoid, that we have to hope doesn't hit us. So I don't know there's a way to avoid it unless everybody gets vaccinated like quickly, which isn't happening because of distribution and because of hard-headed people. Disease X could be coming. And Disease X is the freaking plague. Disease X has been studied for 16 years now. So if you Google Disease X, it's basically a disease that spreads easily and kills a lot of people. And about as bad as Disease X could be would be the spread like a cold, but to kill a third of the people that it gets to.
Yeah.
And
well, it doesn't even need to kill a third of the people. It just needs to get half the people so sick they're knocked out of work.
The idea behind Disease X, which is, a concept that's been out there since the first SARS, is that what the governments are trying to prepare for is if something that's super deadly is easily spread. Usually, a disease that spreads easily is not terribly deadly. And a disease that's really deadly doesn't spread easily. But if you got the worst end of both of that, you could have, again, the Black Death. So, it's been forever since that happened, and I don't think it's going to happen. But what if we just have to do rolling shutdowns again?
Yeah. We shut down again, that's going to be devastating.
Right. So I just want people to be prepared for what could happen. Yeah. And really, again, like I talked about in this article, focus on your asset allocation and really think about what you can afford to lose. So if you're the type of person who's been saying to yourself for 7 or 8 or 9 years, I hate getting 1% in the bank, maybe you should start thinking that I'm okay getting 1% at the bank. I would encourage everybody to have 2 years of expenses in the bank, a couple different banks. I don't want to try to scare people, but we have not, if you go back to my webinars from last year, we have not done the right things on coronavirus. We've been stubborn. We've been selfish. We've made up pretend arguments about freedom. I lean libertarian. Can't get that stuff by me. I understand what freedom is. I don't want the government telling me to do something, but I also don't want my neighbor being a rockhead and getting everybody on the block sick.
Yeah.
So we just have to be prepared. The possibility of a black swan is out there. I don't know where it's coming from. I don't know if it's going to come from COVID. I don't know if it's going to come from China. Right? For a year, 2 years, for a few years, I've been telling you, don't buy commie stocks. And now you see what's going on. At some point, the commie stocks get so cheap, though, that EMQQ becomes interesting. And I'm going to talk about emerging markets here in the next week or two. Emerging markets pretty much have the best projected growth over the next decade. However, it's in the asset light spaces. It's in the cloud. It's in the Internet of Things. Right? Because they're skipping all sorts of things that we've done over the last 50 years. They're saying, why would we do what the Americans did in the 1980s when we can just jump up to this stuff today? And it's in energy, right? It's in medicine. It's in internet technology and how their markets work. So EMQQ, I'm just telling you, it gets down into the 40s, and it sniffs the bottom end of that range that I have out there in the low 40s. That might be one of those weird opportunities to get diversified around the world in a really good set of asset classes across a really good set of countries. And
I think your comments about India was pretty smart too. Honestly, there's a couple of Indonesia and Singapore and India look to me, just with some of the people that I track overseas, look to me like they might be some hot spots once we come out of this.
Yep. And I think Vietnam is interesting because it's a young, educated population.
Yeah, they also are getting a lot of the manufacturing. I noticed that. It was either last month I saw something on that.
Right. There's a lot of politics played with trade, right?
Yeah.
They took our jobs, the old South Park thing. They took our jobs. Well, the reality is that technology takes most jobs, something around like 4 out of 5 jobs that are lost, it's because of technology. And the jobs that moved over to cheap labor
typically are the jobs we don't want.
Largely that, and that wage, Chinese wages have gone up tenfold in the last 20 years. So there's not really jobs going to China anymore. You don't hear about that anymore. So there's not really a huge wage issue between resources and machine learning, and then where the consumers are. Those are the 3 things that drive where the jobs will be. So in the United States, we have a good system, right? Relative, we're very pro capital rights, and we have technology, we have educated labor for the most part, and we have resources, and we have a whole bunch of consumers. And you're seeing Mexico go through the gyrations of becoming a growth economy. And you've got Brazil, which they have a moron running the country right now, but that'll change. And the rest of South America is going to grow too. And most of the South America understand that they want to preserve their environment. And they're going to go high tech and asset light too. And that's where everybody's moving. If you haven't paid attention the last 20 years, I don't know what else to tell you. Asset light is the way to go. You want scalable things. You want to be able to reduce your footprint rather than expand it. There was an article up on margin of safety that I asked Dave to revise. It was on Caesars, so you'll notice it's not up anymore. Well, I took it down because he just missed something that, and I think it's because it's not something he's super familiar with, but Caesars and all the casinos, it's not about building more casinos. It's about getting online revenue, right? How much gambling revenue is going to be online in the future?
Yep.
So, I play World Series of Poker. You know what? I had to fly to Nevada to do it. In the future, it's not going to be that way. I'll be able to do it from Wisconsin someday. The Department of Justice just changed the rules. So all the states can add it if they want to now, and they will. We want to find those places where, you can say, oh, look at this company building this neat thing. Yeah. You know what I'm really interested in? Who programs their computers, right? Who runs their software? What software do they need to do that build that neat thing? Because unless it's an iPhone, there's just not a lot of high margin neat things out there. So, that's really, I just want to take you further into that journey. And I think that's about where I want to get off tonight. I think I'm pretty much through, unless there's any questions. Scott, do you have anything that you're like is jumping out at you? Somebody's asking about GDX.
GDX, I put a chart, not GDX. I think it was gold I threw up. If you want to pull that one up, hold on a second. I'll pull one real quick and send it over.
I found it here, right here.
Yeah.
So I have one up right now too. So if you take a look at his chart. This is a weekly chart. He's pointing down here, is that around 20? And you had at one point said it could get even worse than like a horrible situation. But down around 20, right?
Well, until we get over, we have a weekly close above 1840 in gold. Right now, the count says we're going to 1635 in gold. And the reason is because we now back tested it and it held. So until we close above that 1840, the ABC correction in gold futures is present and it's playing out.
Okay, well, you're talking gold.
Correct.
Okay, so this is the gold miners.
Right.
So this is GDX, not GLD. So this
Correct.
this is saying it could correct down to 1955. Then you have an alternative count at about 25.
Yeah, now that is a harmonic pattern there. Just flip back for the second. Explain what that is. That is the range based on the XABC pattern. If you look all the way to the left of the screen, you see the X down there on the bottom. Mm-hmm. That is an Elliott wave pattern that appears through Harmonics, and they're just images that occur that are repetitive within the wave counts. So right here it's saying is the downside range is between 2478 and 1955 based on that harmonic pattern. Now, are harmonics as accurate as Elliott wave counts themselves? I don't believe so, because I don't use them to trade, because I haven't gotten over a 35% accuracy with them. So I put them there more for a visual than anything else. The count is actually a C down there at, I believe it was 2478.
Right. So here's my chart, and I don't like learning new languages. So I just have the Armageddon line here. And what this is where it crashed to long time ago, got higher, got to the Armageddon line, was supportive, broke through for a hot minute when everything bottomed out, and it hasn't been below it since, right? So, I mean, my Armageddon scenario of around 1820 is not terribly unlike what you showed, but this is clearly a long-term uptrend. It doesn't mean that it can't come down. And this area
well, if you
here,
pull up that gold chart I put in there, let me show you the top side from the bottom. You really should see that, because I tried to put that in perspective, because just, the crazy thing is that I've found that a lot of times when you look at commodities, you can be on both sides of the trade and both be right over time. Okay. So right there, that is your longer term look in gold. So right now, that ABC pattern is in play because it back tested and held the 50-day. So we're looking at a back test to the 200-day next. And then we should be off to the races for a 5, which should give us about $2,800.
Right. And my price target, which I told everybody a year ago on gold, was by about 2024, 25, I see about $3,000 gold. Yeah. Now, the difference in what the gold miners do with the price of gold here or here is not tremendously different, right? Because they still have a ton of cash falling to the bottom line. Whether it's 16, 17, 1800, that's still way above their cost of production, which is down around $1,000, $1,100.
835 is the average.
Depending on what mine and everything else. So if this comes down, and this, I call this the jitterbug zone. This is where it got shaky before it fell. Well, now this representing resistance, and now this area represents support. So if it gets into this jitterbuggy area here, it's probably a buy, unless everything, what's hitting the fan, right? So that's why I tell folks, can it go down into the middle 20s? Absolutely. Does that matter to you, right? Are you holding this for the longer term as some sort of an offset? Some sort of a bond substitute, a corporate bond substitute, because it's got more upside than the corporate bonds, or are you trading it? You have to decide. Now, just because it's here doesn't mean it has to go here. What if the Fed just doesn't back off under Powell? What if the infrastructure bill and the reconciliation are way bigger than people expect and more consequential, and we don't have, what if this market remains irrational for 3 more years? It's clearly irrational. 40 PE, it always leads to bad things. But this could bounce off here and start heading back up. There's not a reason it has to go below this point here. It could be support. And that's at 31 and change. We're currently at 34. Are you really trying to trade it? If you're a position trader longer term, I don't think you do anything. But I get that. But it gets down to this little truck here. I'm backing it up, and I'm filling it back up. So there's that. Somebody asks about Lumen Technologies. Oh my God, it went down. What's new? Nothing. Okay? They did what I told you they were going to do 2.5 years ago. They sold off part of the consumer division, which is good for them. They sold off a low margin business, got cash and debt relief to focus on fiber, which is the backbone of the internet. And as you can tell from the trucks that are out there, they're trying to get fiber to every business in America. And Lumen is the second biggest fiber provider. So either they just start making a ton more money, or somebody buys them. Somebody asks, well, are they going to suddenly lower their dividend? The dividends have already been cut once, and the cash flow is improved. So they don't have any problems. So if somebody's going to ask me if the dividend's going to fall, don't ask me as an emotional reaction to a price move. Ask me based on the change in the business. Right? Well,
considering we had a drawdown, it was nowhere near as deep as it could have been.
So somebody reacted to this move in the chart. It's been drifting down. It's just in the range. It's in that jitterbug zone. Could it go back down to here? Yeah, you'll be lucky if it does, because then you load up on it. It's a very
actually I had a count not too much lower than that. I'm trying to find it here real quick so I can quote it, but I had a C down there at 1054, and that would be a wave 2 down, and the wave that should follow that should be an extensive uptrend, maybe to 25 bucks. So 1054 is my completion of C down, and it's really a zigzag. It's not even a really deep, it coming off the 1660, that push.
So what price did you say?
1054.
No, the next price, the next leg up.
24.19. And that's a 3. Let me go a little bit further here. A 3. 4 will come in back about 1813, and then our final 5 should put us up there. Is all the way up at 81.
So folks, are you starting to notice, because I've been putting the target prices up here, starting to notice that different technical methods kind of lead in the same direction? Part of that is because technical methods largely are responsive to what's already happened.
Yeah, representations of price.
Right. And then people adopt the technical method, and a lot of people end up at the same place because it's validating where they've already been.
Yep.
And that tells them where they think they're going to go. Right. So there's that.
I have no problem with Lumen. I mean, yeah. I mean, it's clean. So,
right. So, I don't show everything on my charts to the public because it's just a lot of stuff. But down here, you're basically seeing it. I actually like this one. It makes life real easy because it takes multiple rolling moving averages. It's usually pretty on the money. If we wanted to trade shorter term, I would have told you. Right here, I knew as it started to come down, it was going to keep going down for a while. Now, this says that not much left to go down. Well, what does Elliott Wave tell you? Not much left to go down. So they all end up telling you similar things. There's similar stories. And it's just like when somebody is results oriented. What does results oriented mean? It doesn't mean what you think it means. It means that they change their opinion based on the results. So they don't say, I would like to see this happen. They say, oh, that happened, therefore now I support it. And most technical analysts out there are just using something similar and tweaked. An Elliott Wave theoretically is a representation of the emotions in the market, and the
emotions of buyers and sellers.
Right, and so the waves, the repetition of the waves, the number of patterns that there are, those are the patterns that usually happen. It has something to do with psychology. Now, I have never found the numbers in Elliott Wave to be all that great. Not any better than anything else, right? Not any worse, not any better. But the way of trying to explain it into the psyche, right, to try to use it to understand psychology, I think is remarkably helpful. So, and when you can narrow it down using other factors to get the success rates on the trades, now all of a sudden you've got a really big winner. Now, like with the Harmonics, I think it's pretty. I think it helps people understand, but I've never been able to use it to be predictive. And I've used all this stuff over the last 25 years. And I've just simplified it down to, look, if I can understand a company better than 99% of the people out there, that's probably my strength. So I should focus on that. I had over 20 10 baggers. I showed somebody my portfolio balance and my holdings in Vegas because he was just talking and talking and talking. I said, well, this is what I do. And then he says, there's another real famous guy on the internet that says to just put your money into index funds. I'm like, yeah, if you don't understand how companies work, yeah, that's fine. I mean, you'll just be average because that's what
Heck,
the
that's
index
no fun.
does. Yeah, I said an index.
But then
is
again,
average.
I've got 18% in indexes over in my 401k.
Yeah. Well, and so I told him, I said, if you had your money in indexes from 2000 to 2009, you would have made zero. What? You would have made zero. You would have got the coupon rate. You would have made about 2%. That's not true. And I showed him the chart. He goes, well, how do you pick out companies? And I showed him. And he looked at the number on there. He goes, that's your account? I go, yeah, it's my account. Oh, you're rich. I'm not rich. If I lived in California or New York, I'm not rich. I'm rich in the Midwest, maybe. I ain't rich in California or New York. So, when we pick out companies, I just, when I see people quit the service, it just kind of blows my mind. And it's because I probably didn't get through to them. I'm just telling you, I'm right on these companies around 70% of the time, which is 20% better than Kramer. And I pick out way more 10 baggers and 5 baggers and 3 baggers than he does. You need to go through like 2 cycles with me. Take about a decade. And you're going to retire. You got $100,000 today. You're going to end up with $1 million plus in 10 years. That's just how it works. You pick out the right companies. When the correction in the fall happened, you saw what I did. I backed off the bearishness. I said, okay, we need to buy some of this stuff. There's just so much money out there.
To SPY.
What was that?
That's a good lead to the SPY. Pull up the SPY. It's morphed. Yeah. Okay, now notice how we morphed there. We were expecting about an 8% correction off of that last retrace. It didn't happen.
Right.
So the wave count is now modified. So when we get up to that 474, we're now going to have that full drawdown. It's just moved to that point. Now that's going to be really choppy. I'm just telling you. I mean, I would suspect that during that move, a lot of you, even with the positions that you're in, are going to take some heat. So you need to decide how to manage that from a risk standpoint individually. But realize once I start putting on the shorts in the SPY, and I'll be putting those on in the room, you can probably sell the other direction with a decent amount of comfort, unless your broker raises the margins that prohibits us from doing that or takes us out of those trades. Because I started to see that on that last drawdown. They actually took me out. I had like 1,500 SPX contracts, and they took me out of like 20% of them because they pushed the margin to 300%.
Right. So if you're not a trader, then all you want to do is scale out of this market to wherever your minimum pain point would be on a big correction and hold cash, because the day will come and have a plan for what you're going to do with that cash when the market gets certain numbers. There's also a handful of investments that'll go up in price, long only investments. So we can do that. You don't have to be on margin. I mean, none of us are on margin. At least I don't recommend margin unless you're really.
No, I don't actually use margin. Even in a cash account, when you're trading futures and options, if you're pushing enough money in one transaction, they still are going to tag some level to you. I mean, the majority of the accounts I trade with are cash accounts, and I just get so heavy in volume sometimes in those accounts, they actually throw a margin call at you.
So what I'm telling folks is that if you're not a trader, don't suddenly try to become a trader. Do it incrementally. Read the book that I told you to read, and learn the things you need to learn on the technical side, because trading is largely technical, right? It's almost all technical. Fundamentals play out over a longer period. Now, this fall here, I've been waiting to buy some puts on the S&P 500. And because of the one bad trade I made last year with oil, or 2 years ago, whenever it was, I'm very, very careful about buying puts. I'd rather wait in cash because there's almost no risk in cash. And it used to be that you could buy TLT and make a ton of money when the stock market went down, but TLT already rallied. So can TLT rally even more? Can the 10-year treasury go to like 0.5%? I guess, I don't know. So we already have negative real rates.
I think I threw a TLT chart in there too, if you want to pull it up.
Yeah, I mean, it's just, I think TLT is really hard to trade right now because it could get smashed. I mean, it could just get smashed.
That's just why I wait for the back. I do pretty well as long as I stick with the back test. The only time I've ever gotten hit on TLT is when I didn't Didn't wait for the back test.
Yeah. I mean, I don't think, back in some of these other corrections when TLT, when the 10-year treasury, 20-year treasuries were higher up, it made sense that interest rates would drop a point. But how are they going to drop a point from here, right? So there's just not a lot of upside to TLT. The U.S. Treasury does not offer a lot of upside, not really any more than a money market account in many cases. There's just not a lot of upside. And if the correction is caused by rising interest rates, you lose on that too. So I don't know what long investments there are for a corrective market at this point. I think you can only buy puts or short things.
Well, something that might work is, you can buy VIX common too as a hedge. I mean, and even though I don't like 3X funds, I don't like them because I've been taken out of too many when they've done their price adjustments. But from a short-term position for like a week, if we get risk off and you need to hedge and you don't want to exit some of your dividends positions, we can start posting numbers to the VIXs and they're pretty decent trades on the upside. And I think, I don't know if I posted it. Matter of fact, I don't believe I did, but we got some upside on the VXX,
right,
probably 50% from where we are now
right,
when we hit that 3 drawdown. So, I mean, it'll be a decent yielding common share purchase you could do just buying VXX.
So we've done 4 VIX trades in 3.5 years.
Mm-hmm.
And we had one that was huge to the upside. I mean, people made 600%, 700%, 800%.
Mm-hmm.
And then the other 2 were small wins, and the other one was a break-even small loss, depending on where you traded it.
It's a win. It's a win.
Yeah. The problem with VIX is obviously it's a daily. Basically, it's for day traders. If you use options on the VIX, time just works against you so fast. So you
either got to catch it before the move, otherwise you already got so much decay in it, it's not worth jumping in.
You don't just have to catch it before the move. You have to catch it right before the move.
Yep.
So, again, some of these hedges, they're not for, I'm going to set it and forget it.
Mm-hmm.
You have to be a swing trader to do it. Otherwise, if you're not a swing trader, your hedge
presents
cash.
Another level of risk. I agree.
Yeah, your hedge is risk. Your hedge is cash. And so for most folks, I'm just saying be on the work your way to the conservative edge of your asset allocation model, mm-hmm. Which I think, I've laid that out in the articles. If you are a very aggressive investor, 10 to 20% in cash. If you are kind of middle of the road investor, 20 to 30% in cash. And if you're a retiree and you're like, I would puke if I lost 30% of my portfolio, then it's okay to be 50, 60% in cash short term.
It's even okay to be 90% if you have that much, if you're going to take that much heat.
Yeah, I never tell people to go over 75%. And the reason for that is in the very long run, we know that a portfolio of 25% equities and 25% shorter term fixed income is enough to offset inflation forever, even with money printing. Mm-hmm. So I never really want people under 25% equities. Maybe you pick them differently, but the stocks that we're in right now, we've bought a whole bunch of stocks that haven't moved, whether the market goes up or down. Mm-hmm. What does that tell you about those stocks? They're fine companies. They're just waiting for somebody to get interested. And, I'll tell you what, in that basket of stocks that I have, that I showed you my holdings.
Nothing wrong with relative strength.
Well, I think relative strength is super important in the long run. And when you're trading, but value priced growth. If you can get growth at a value price, which is what I'm doing, you're going to get a lot of triples, quadruples, quintuples, and some 10 baggers. I think those satellite stocks, one of those companies is going to go up 10, 20, 30 fold, huge. And the other ones will probably do pretty well and probably be a merger in there, I told you. because at some point there's just too many satellites. Some of the other stocks, Open Door, On Track. I mean, these are companies that can just churn out massive cash, just as the systems in the world change. As real estate commissions go from knob real estate agents who don't know what they're talking about, and they're just trying to get in between your money and the seller's money, buyer, seller, and seller's money, right? Real estate brokers, I think that in my experience, less than 1 in 5 offers any value at all. So Open Door is going to capitalize on that. And On Track, mental health.
Well, they're putting themselves, their big chunk of their revenue is because they're putting themselves in between the homeowner and the realtor. They're getting a piece of the transaction. They're replacing
the realtor is what they're doing.
It's still they're still, like I've got an On Track listed in my neighborhood, and
Open Door you got.
I'm in Open Door. Yeah. And, they're putting themselves right in the middle, and it's all the local realtors who are still showing. I mean, that's the ultimate thing on the buyer side, is that realtor is the person that really communicates with the buyer, unless they're an investor or they're doing a virtual purchase, which is, of course, is increasing too. That's another area that I think will be booming in the next 5 years.
And Open Door is the biggest home flipper in America, because they go in there and they'll say, well, we'll just buy your house. So, there you go. Save the 6% commission, 5% commission. All the discount brokers, what technology do they offer? What real service do they offer? Well, I'm going to fill out your paperwork for you. I pay a lawyer $600 to get that done. So, discount brokers are better than high commission brokers that offer no value. But if the technology is going to do it, and more people are just going to have an app and go to a house, and the app's going to let them in the door, which is what's happening next. It's already starting to get installed. There's a lot.
Opens a buy, by the way.
What was that?
Opens a buy. I just put in a 2 at the 14.11. Yeah. Should go up to 22.
Yeah, no, I love Open Door. I think Open Door is $100 stock someday. So in any case, we strayed. I said goodbye 25 minutes ago, so I'm gonna say goodbye again. And I'll get this edited in the morning and up for folks. But I think there's a lot of good things going on out there. Somebody asked about SunPower. I'll write up a little something on that. I'll do some investment quick thoughts. I don't know how low SunPower can go. Looks like it can get under 20 for a hot minute. If it does, it's a gift. And in the short run, it could happen. And it could happen quick, because the infrastructure bill has some green in it. But the reconciliation is going to be a big deal. And Ford in particular is going to benefit from the reconciliation bill. So, if you want to really think things through as to what's going on in the future, read what it looks like is coming with the reconciliation bill. That's the future of the U.S. economy. All right, let everybody go. I'll get this dialed up for you tomorrow. Thanks a lot, Scott.
Thanks, Kurt. Thanks for having us.
Take care.